Thank you for having me here. It's good to be back in Wilmington. What I thought I might do is just spend 10 minutes and talk about the economy. I trust you're interested in that. I might even focus particularly on the labor market. A lot of small businesses here, and I hear from a lot of the small businesses I talk to that this is a place of real focus. And then I'm really looking forward to your questions, so I won't waste your time speaking. I'll get to the questions. As an aside, I think I was here in 2019, and I taught a class at the business school, so the hurdle for questions here is very high. We'll see if you're better than the students or not. Everything I say is my perspective only, not that of anyone else in the Federal Reserve System. That'll free me up to say exactly what I think. So let me just start by giving you a couple words on the U.S. economy, because it's proven incredibly resilient. As you know, the Fed has raised rates 525 basis points in the last year and a half to fight inflation, and yet GDP remains quite solid. It grew 2.1% in the second quarter. That's a little bit over the normal rate. S&P Global, which is a pretty good forecaster, updated its forecast this morning, and it forecasts third quarter GDP growth of 5.1%. Now, this growth has been in no small part due to the consumer, who's continued to spend down pandemic-era savings, benefit from higher wages, and also rising equity and house valuations. Unemployment, we'll get a new number tomorrow, but right now unemployment's at 3.8%. At the same time, inflation has started to settle. In August, the 12-month headline PCE inflation was 3.5%. That's down more than half from its peak of 7.1% in June of 2022. Core inflation was at 3.9%. Gas prices have fallen from last year's highs. Supply chains have largely opened up. And the Fed's monetary policy moves have started to have their effect, particularly on interest-sensitive sectors like housing, commercial real estate, and deal-making. So you might ask, where are demand and inflation going to go from here? It's hard to know. There are those who believe that inflation is going to settle further without much additional erosion of demand. There are those who believe the fight against inflation is going to require a more significant slowdown. And I believe that the answer to which of those two is the right path depends on what happens in the labor market. And I'll just say, everywhere I go, from farms to factories to ballparks, I still hear that labor is short. Yes, hiring is a lot easier today than it was in early 2022. Yes, the Great Resignation has largely passed, particularly for professionals. And yes, people are slowly coming back to the workforce and even the office. But easier and better isn't the same as back to normal. Demand is still healthy. We got initial claims this morning. It came in at lower than 2019 levels. And for many employers, the labor market still feels out of balance. And if good workers remain hard to find, then wages could rise further. That would pressure margins and prices in turn. So I want to spend my time today digging into what I think is happening in the labor market and where it might go from here. And if you'll forgive me, I'll start with some math. In February of 2020, 61.1% of the population was employed. Today, that number is down 0.7 percentage points, or nearly 2 million workers, at a time when GDP has expanded over 6% since before the pandemic. And the gap between the growth in GNP and the reduction in workforce helps explain why labor feels so short. It is. Why is that? Well, demographics play a role. Some of this was predictable due to the natural aging of the baby boomer generation, but the rest of the gap is almost entirely attributable to lower participation rates for those at or near retirement age. Perhaps they're being supported by stronger 401k plans, or maybe even they're taking care of their grandkids. Demographers have forecasted this reduction in the workforce for years. For decades, our economy operated with a growing labor force. We benefited from the baby boom, from women more fully entering the workforce, from increased educational attainment, which better prepared workers, from improved health, which led to longer careers, and from historically high levels of immigration. And all of this was supplemented by access to ever-growing pools of low-cost offshore labor. But those tailwinds look like they're changing, and they're becoming headwinds. The growth of the working-age population is relatively straightforward to forecast, and predictions aren't good. Fertility rates are down. K-12 school enrollment is projected to decline by nearly 8% over the next 10 years. My generation is aging out of the workforce. Immigration policy looks unlikely to materially change anytime soon. And offshoring has been complicated by increased awareness of the risk associated with dependence on foreign labor sources. But it's more than just the overall numbers that are discombobulating employers. It's not just the level of supply, but it's the distribution. What do I mean by that? Well, over time, employers had become comfortable with where their jobs rated versus those jobs that were offered by others. Think of it as a job hierarchy. You knew the level of investment you needed to make in wages and benefits and working conditions in order to hire and keep the workers that you needed in what was a relatively stable marketplace. But the pandemic era seems to me to have reshuffled that hierarchy. It's made the job market less predictable, and it's left a lot of employers scrambling. 3 things happened during COVID-19. The first was a shift in relative compensation. Firms didn't sit idly by as the pandemic created labor shortages. Growth sectors, like warehousing, filled their needs by offering high entry wages. Employers that found themselves short offered new perks or higher wages to convince workers to come. In leisure and hospitality, for example, wages have increased a lot faster than they have in the private sector overall. Segments that struggled to find the money to raise wages, like state and local governments, fell behind. The second shift was that just objectively, the COVID experience made a number of jobs less attractive. Whole sectors like restaurants or theme parks shut down, sending a message that maybe those sectors weren't as secure as they had seemed previously. If you were in a manufacturing operation and you had supply chain challenges, the stress increased enormously. And for jobs like teachers or nurses or childcare providers, which had historically earned points for the revered roles they hold in our society, the pandemic also crystallized that they faced higher health risks, at least during a crisis. Then the third shift was a shift in employee attitudes, and the most obvious place is in preference for remote work. Jobs that can provide days at home have rocketed up the hierarchy. But there seems to be an even broader change in employee willingness to trade off work and home. I travel every week trying to talk to businesses about what's happening. I ask them, what they see in the workforce. I hear lots of interesting things. I talked to a coal company, and you remember in West Virginia, coal companies are the highest payers. They can't hire miners because cell phones don't work in the mine shaft, and employees aren't willing to go in a mine shaft without their cell phones. I talked to a manufacturer in South Carolina that was losing workers to the Bojangles down the street. Now, the pay gap shrunk. Their pay had gone up a little, Bojangles' pay had gone up a lot. But the real issue seemed to be work schedules and the ability to work indoors. Conditions taken in stride prior to the pandemic, like last-minute overtime shifts or grueling physical labor, seem to require more of a premium now. So if that's the case, what are employers doing? Well, they're not standing still. Many are investing to increase the supply of labor. That's good for workers, that's good for growth, and that's good for reducing inflation. I hear of a number of efforts to bring in new workers off the sidelines, training partnerships with community colleges, apprenticeships and internships, investments to reduce barriers to work, like transportation, childcare, and access to housing. This investment might be particularly important given the impact of the pandemic on the preparedness of a lot of those entering the workforce. I talked to other employers who are investing to reduce demand for labor. And you can see that clearly in hotels, where housekeeping has become optional and many lounges are still closed. More fundamentally, wage and staffing pressure has made automation just a lot more compelling economically. McKinsey estimates that automation, including artificial intelligence, could replace 30% of the hours worked in the United States by 2030. Now, all else equal, investments in automation are likely disinflationary and increase capacity for growth. But while there's a lot of buzz about it, it's also not going to happen overnight. And then finally, we're of course seeing employers fight their way up the job hierarchy by adjusting wages, benefits, and the work environment. Some are doing so by improving working conditions, limiting overtime or last-minute scheduling, installing air conditioning, offering more flexible work arrangements. But those employers who can afford to reprice their jobs are still doing so. They're raising their wages to remain competitive. After all, workers are expecting more now. The New York Fed does a survey of consumer expectations. It suggests that the average reservation wage, which is the lowest wage a worker says they would accept to take a new job, has increased over 20% from before the pandemic. This has, of course, been quite visible in recent negotiations in parcel companies, in airlines, and now autos, but it's true in non-union environments too. And it's worth noting that wages generally only move in one direction. Those who are ahead of the curve are not going to be able to cut wages, and those who are losing out on workers eventually will raise them. And the net impact of that at scale would be inflationary, barring any adjustments to monetary policy. Now, it's hard to know how all this is going to balance out. Will labor supply come back even further as employers invest in training and retirees find themselves bored or squeezed? Will labor demand settle as automation rolls out or the economy weakens? Will employees return to their pre-COVID preferences? Or will employers bite the bullet and increase wages and then prices even further? The range of potential outcomes to me is still pretty broad. I mean, you could articulate the case for a resurgence, you could articulate the case for a slowdown, you could articulate the case for a return to a pre-COVID economy. And the breadth of those scenarios is why I was very comfortable supporting our decision at the last meeting to hold rates steady. We have time to see if we've done enough or whether there's more work to do. The path forward to me depends on whether we can convince ourselves inflationary pressures are behind us or whether we see them persisting. And I'll be watching the labor market closely for those signals. And with that, I'll turn it over to our next presenter, and I look forward to your questions after his talk. Thank you.